Before I introduce Robert Goodman, just one additional answer to the question that was asked before the break. As Joel pointed out to me at the break, that the real value of the CGL policy is that it has unlimited defense cost recovery capability, and that's one of the big values of the CGL policy. To the person who sent in the question live streaming, you know, what are the damages? The likelihood is that the greater damages had to do with defense costs. So with that, I'd like to introduce Robert Goodman, a partner from our Newark office, who also works out of New York. Robert is an insurance coverage lawyer and commercial litigator who's just recently joined us. And Robert is going to talk about a more specialized look at cyber insurance litigation. So Robert.
Thank you, Jim. As Jim mentions, I'm an insurance coverage lawyer. I also do other kinds of litigation and other types of insurance litigation. I mostly represent insurers, so I want that bias out front at the beginning. As you heard from Joel, coverage for data breach related losses under what we can call the standard policies is at this point uncertain at best. Cyber insurance, in its many forms, tries to address gaps in coverage that may arise under the traditional policies. They can provide both first-party coverage for costs incurred by the policyholder in responding to a covered event, and also third-party coverage for claims by third parties alleging injury as a result of an alleged breach. As Joel discussed, as insurers have increasingly excluded cyber coverage under the traditional policies, they have begun to also provide cyber risk endorsements. And they also have provided a number of standalone cyber liability policies. As these are relatively new products, there are no standardized policies. You probably already have heard that about 5 times today, and you'll hear it some more. And there's fairly little case law interpreting these policy provisions. I should move this along. Also, given the ever-evolving nature of the cyber crimes themselves, I think we can anticipate that the products that the insurance industry is going to be offering will themselves further evolve. And these newer policies are also going to require even further judicial interpretation. However, we can provide a snapshot, and that's really all it is, of the early case law in what's certain to be a fluid and not entirely predictable legal environment. And one overriding theme that I think will emerge is that depending on the precise policy wording, this coverage is not necessarily a panacea for all types of losses. In other words, just because you can say, well, I've got a cyber risk endorsement or I have a cyber policy, I should be set. It depends a whole lot on what the endorsement or the policy says. It also depends on the court, depends on the facts. So one type of protection offered by insurers, either by way of endorsement or a provision in the body of the policy, is limited coverage for what's called in the policies computer fraud or computer system fraud. And those words have been the subject of a lot of scrutiny by the courts. A key issue under these types of policies or endorsements has been whether the loss was a direct result of the use of a computer. a subcategory of these types of cases concerns whether the loss was the result of hacking versus result of phishing. And we'll talk about the difference between hacking and phishing. I'm sure all of you, being a sophisticated audience, knows the difference, but we'll get into that a little bit. So one strand of cases, you've had courts that have held that certain losses were not the direct result of the use of the computer, as often required by the policy language or the applicable endorsement. A very recent example of a case like this was Incom Holdings versus Great American. That was decided just in March of this year. And in Incom, the Northern District of Georgia held that coverage for computer fraud did not cover $11.4 million in fraudulent debit card redemptions, which were made over the phone. And to give you a little bit of the facts, Incom provided a service that allowed customers to loan funds into debit cards issued by third-party banks and sold by retailers. The retailers sent to Incom the payment made for the card, which the cardholder could redeem by calling Incom, which then transferred funds into the issuing bank for the cardholder to draw upon. The losses in this case involved debit cards issued by Bancorp. A coding error in the Incom system allowed cardholders to redeem the cards more than once, which resulted in the loss in the case, as I say, $11.4 million in unauthorized charges. Now, the policy's computer fraud provision stated that Great American would pay for loss resulting directly, again, there's that word directly, resulting directly from use of any computer to fraudulently cause a transfer of property. Great American denied coverage. They said the credit card redemptions were made over the phone, not by use of a computer. And they also said, look, the losses were the result of charges made to the cards after they were redeemed, and thus they were not directly due to the unauthorized redemptions. The court agreed, reasoning that cardholders used phones to make the unauthorized redemption, even if the transactions were processed by use of a computer at Incom's end. The court said, and you get this kind of language in many of these cases, that the fact that a computer was somehow involved in the loss does not establish that the wrongdoer used a computer to cause the loss. As I say, you're going to see that in a lot of these cases. Another leading case was Pest Services versus Travelers. The Ninth Circuit affirmed the Central District of California's holding that the policyholders' losses did not flow immediately and directly from the wrongdoer's use of a computer. This was a crime protection policy case. It defined a computer fraud, but it did have a provision dealing with use of a computer fraud. And it defined computer fraud as the use of any computer to fraudulently cause a transfer of money. Now, what were the facts? The underlying fraud was committed by a payroll contractor against the policyholder. The contractor had been hired to withhold and submit payments for the policyholder's payroll taxes. Instead, the contractor fraudulently used the policyholder's funds to pay its own expenses, which ultimately left the policyholder indebted to the IRS for the payroll taxes. The district court ruled in favor of Travelers because the claimed losses did not flow immediately and directly from the contractor's use of a computer. I'm seeing a lot of faces out in the audience that people are saying, could these possibly be correct results? The court said there was no loss when the funds were initially transferred to the contractor because the transfers were authorized at that point by the policyholder. Appealed to the Ninth Circuit. The Ninth Circuit affirmed and said the phrase fraudulently cause a transfer has to require an unauthorized transfer of funds. Here, the computers, and they said, look, because computers are used in almost every business transaction these days, if you read the phrase, fraud, the use of a computer to cover all transfers, you're going to convert this policy into a general fraud policy. And that couldn't have been what was intended. Okay, so we've got a trend going. Another credit card case was Pinnacle. The Western District of Washington also rejected a claim under a computer fraud endorsement arising from fraudulent credit card transactions because the policyholder did not suffer a loss directly from the use of a computer. Emily's going to tell us how to get around decisions.
I don't know.
The policyholder sought coverage for losses it sustained when it satisfied a contractual obligation to replace over $36,000 in funds lost by a financial institution that was the victim of fraudulent credit card chargebacks made via computer. The court granted summary judgment in favor of Hartford, finding that the policyholder's loss was not direct because it did not flow immediately from computer fraud, and it cited a number of intervening agencies or steps, and they cited, look, you've got a bank being unable to recover its chargebacks, you have the bank's deduction of money from a reserve account that the policyholder was required to fund. You had the policyholder satisfying its contractual obligation to replenish the reserve account. The court said, well, to interpret the term direct, to apply to such an attenuated chain of events would be to create an ambiguity where none existed. And the court went on to say, if you were to adopt that interpretation, you basically would eliminate, you would render the word directly superfluous in the policy, and there'd be no difference between the phrase caused by use of a computer and directly caused by use of a computer. So that was another case that went in favor of the insurer. A somewhat different set of facts, but a similar result occurred in the Brightpoint case, Brightpoint versus Zurich. There you had the Southern District of Indiana granting summary judgment to Zurich upon a finding that a loss resulting from a fraudulent conversion of prepaid phone cards was not a direct loss and thus not covered under a computer fraud provision of a crime policy. And the facts of the Brightpoint case was that the policyholder distributed prepaid phone cards through a dealer in the Philippines. The dealer would send copies of post-dated checks and bank guarantees to Brightpoint with its purchase order. On receipt, Brightpoint purchased the phone cards and physically delivered them to the dealer in exchange for original checks and guarantees. After one such delivery, the dealer refused to pay for a shipment of phone cards, claiming that it had not authorized its representative to pick up the phone cards or to issue the guarantees. Okay, how did the court arrive at a determination of no coverage? The court held that there was not a direct loss, and in so holding, the court focused on the physical delivery of the phone cards. Although the post-dated checks and the guarantees were transmitted electronically, the transmission was not the proximate cause of the theft of the phone cards, because the phone cards themselves were not transmitted electronically, but rather in a physical meeting. So because a physical meeting was required, the court said the loss is not a direct result of use of the computer. Okay. Moving to hacking and phishing, you have this strand of cases where several courts have grappled with the difference between coverage for hacking, which is usually defined as an outside party breaking into a company's data, versus phishing, which we think of as a third party fraudulently inducing a company employee to expose data or transfer funds. Is that, Emily, is that about right? That's, you got hacking, phishing. There have been a number of, and again, there are not a lot of cases in any of these areas. But you got a couple cases in the hacking area. And they kind of go both ways. In the Bank of Bellington case, you had a financial institution bond that covered loss resulting directly from a fraudulent entry of electronic data within any computer system operated by the insured. The bond also included several exclusions, including one for losses caused by and the language, again, is always important. There was an exclusion for losses caused by a director or employee of the insured. Bellingham's claim arose from fraudulent wire transfers caused by a computer virus after an employee inadvertently left the computer on overnight. I leave my computer on overnight all the time. I guess I shouldn't. But so the employee leaves the computer on. A computer virus apparently is somehow gets into the system, somehow as a result. The district court rules in favor of the policyholder, and the Eighth Circuit affirms. So the policyholder wins this one. The reasoning is that even if the employee's negligent actions played some role in the loss, and those actions created a risk of intrusion into Bellingham's computer system, the intrusion and the ensuing loss of funds was at that point not certain or inevitable. According to the court, the overriding cause of the loss was the criminal activity of the third party, i.e. the hacking. So there, the decision was, look, you may have had this other stuff going on, but what's really, quote unquote, the cause is the hacking. Now, a case from this same court, which was the Western District of, oh, I'm sorry, I thought it was the same court. You had a case that goes the other way. Very similar fact pattern, very different reasoning, and I think the key factor is the policy language and specifically the language of the exclusion. In this case, the Aquastar case, Aquastar's losses were covered. The issue was whether Aquastar's losses were covered under a RAP Plus crime policy, which covered losses directly caused by computer fraud. And again, the coverage was subject to a number of exclusions. The policyholder was a seafood importer that did business with a vendor, Longwy. The hacker apparently monitored email exchanges between Aquastar and the vendor. it began sending spoofed emails, and at some point started, to direct Aquastar to, instead of sending funds to the vendor, we've changed our address, send them to this new address instead. Aquastar did it and was defrauded by the hacker. Aquastar sought coverage from Travelers, which denied the claim, said, this wasn't caused directly by computer fraud, and also several of the policy exclusions apply. And the Western District of Washington ruled in favor of Travelers and held that an exclusion providing that the policy will not apply to a loss directly or indirectly caused by the input of electronic data by a natural person having authority to enter the insured's computer system barred coverage. So what's the distinction between these two cases? I think first and foremost is the fact that the Aquastar policy expressly excluded loss indirectly, not just directly, but indirectly resulting from input of data by an authorized employee. And secondly, the scheme in Aquastar required action on the part of the employee following the original emails from the hacker. So in essence, it's a sort of a combination hacking, phishing scam. What about phishing? I'd say that the leading case for the distinction between hacking and phishing is a New York Court of Appeals case. That's the highest court in New York State, in the Universal American versus National Union case just a couple years ago. And the Court of Appeals said that a financial institution bond writer for computer system fraud, which covered fraudulent entry of electronic data into the insured's computer system, was only intended to apply to unauthorized hacking and did not extend to losses resulting from entry of fraudulent information by authorized users that was resulted in payment of claims for services that, in that case, were not actually performed. So it said, look at when you, again, it's sort of this paradigm distinction. Hacking is when a third party gets into your system somehow. Phishing is when an employee is tricked into providing either access or the transfer of funds. And the New York Court of Appeals said that under this particular policy, it covers hacking, not phishing. Another case, Emily's like shaking her head.
No, it's frustrating that to me, they're so overlapping, hacking and phishing attacks, right? So they would both be covered under cyber. Part of it, not necessarily some of the dollar damages, but the fact that to me, it feels a little like hair splitting because the coverage, again, that I place for clients, it's unauthorized access, unauthorized use. They're just very closely intertwined. That's why I was shaking my head.
And so what lawyers do after the fact is hair splitting.
Yeah, okay. I'm not a lawyer.
And so when we hair split on behalf of our clients.
Right.
And as Joel and I have both demonstrated, there's, in the case law, plenty to work with no matter who your client is. What you need to do, however, is go to a good broker, Willis or another good broker, who knows this area and who, frankly, I think you're aware of some of these cases because they shape the marketplace.
They do.
And when you have some of these results, brokers and insurers will come up with products that will address the gaps in the coverage that, frankly, the case law has revealed. So let me talk about a case that there's another case denying coverage in the phishing context, and that was Apache. I won't spend a lot of time talking about it, but again, and I said at the outset, these are in a sense a subcategory of the direct-indirect cases, and they often say, well, look at if you've got somebody coming in, that's a direct loss. If it has to go through a number of steps, it's an indirect loss. And Apache, again, this language in a crime policy provided loss resulting directly from the use of a computer. The incident there, it was a phishing scam. The phisher sent a fraudulent email to a secretary. The secretary, she takes it to another employee. The other employee takes it to a supervisor, and they ultimately decide, it looks real. And we're going to honor whatever this email was, and as a result, the policyholder is defrauded out of $2.4 million. And it was clear, I think it's a paradigm phishing sort of situation. Policyholder sought coverage, prevailed in the district court. The Fifth Circuit said no. And again, this theme that you find in some of these cases, courts are definitely concerned about not making every fraud a computer fraud. And they say that in this case as well. They rely on some of the earlier cases, Pestmaster, Bryce Point. They say that the email was merely incidental to the fraudulent scheme. And the court held to construe the policy otherwise would be to convert a computer fraud provision into a general fraud provision, given the ubiquity of computer usage in modern business. So let's remember what this is intended to cover and not turn it into an all-purposes fraud coverage. Now, there is one of these, principle, where the policyholder won. And there you had policy language that I think, at least arguably, and I'll say arguably because you remember I do represent insurance companies, arguably it covered a phishing scam. And the court there did not get caught up in the indirect-direct issue. There you had, and because there was this direct language in the policy, the commercial crime policy provided coverage for loss resulting directly from what it called a fraudulent direction, or fraudulent instruction. Now, i.e., that could be phishing. For fraudulent instruction, directing a financial institution to transfer, pay, or deliver money or securities. The policyholder, principal, lost over $1.7 million in a scam that included several steps after an initial email impersonating the company's president. The policyholder said, look, this was a direct result of a fraudulent instruction. In support of the denial of coverage, the insurer argued, well, the loss was not direct because additional information was required for the wire to be conveyed to principal after this initial email. And also, principal's employees set up and approved the wire transfer. So the court said, well, look, both of those interpretations are reasonable. The policy language is susceptible to both interpretations, and relied on this maxim that you find in some of the some of the cases where if a policy provision is ambiguous, some courts say that means the insurer loses. Ambiguous policy provisions are construed against the insurer. Now, not all courts say that. Some courts look at whether there was a sophisticated party on the other side, but some courts will say, we're going to look at, is this ambiguous? And if it's ambiguous, we're going to construe it against the insurer. The other thing that court did was it said, well, look, if we deny coverage on the basis that employees were involved, that would render the coverage illusory, because the only way that principal could act would be through its employees. So those are two main, if you do insurance coverage cases, those are two main arguments that you could put into almost any policyholder brief, is that the provision is ambiguous, construe it against the insurer, and if you deny coverage, then the coverage was illusory. So we win. So this was clearly a pro-policyholder court, depending on your point of view. I'm actually going to skip this case. It's a kind of narrow issue. The facts were kind of specific, and if you have claims under the Telephone Consumer Protection Act, or if you have claims under the Consumer Fraud Act, both of which were involved in this case, you may want to look at this case. You've got the citation. It's sort of a one-off as far as I'm concerned, but you may want to consult it if those issues are something you're concerned about. So I do want to spend a little time talking about the broader cyber liability policies, although Emily's going to talk about them mostly. You've heard many times already that cyber insurance is a developing product. I've seen the figure, and I've heard different figures today, but I've heard the figure that there are 70 different insurers selling cyber insurance in the US commercial market today. Now, they may not all be big players, but there are a lot of people out there selling a lot of different products. As Emily will discuss, the wordings in these different policies vary, and the differences in the policy wordings from one cyber policy to the next can be significant. And I think that's one of the takeaways from some of these early cases. Frankly, the cases I've been talking about, where generally speaking the insurer has won, these mostly arise from some of the early generation of cyber endorsements and cyber policies. And there have been changes in some of the later products. But the takeaway is what the policy says matters. And you have to read the policy, and when you're buying coverage, you have to read what the proposed policy says. So now, mostly, as I say, there's not been a lot of case law. Generally, the language has been untested, and in order to demonstrate that, my associate, who is sitting in the room, to try to convince me that there was very little case law out there. She told me that a Westlaw search of the term cyber risk policy in all state and federal cases produced 0 results. A Westlaw search of the term cyber insurance policy in all state and federal cases produced 0 results. And a Westlaw search of the term cyber liability policy in all state and federal cases produced 1 result. So there is not a lot out there. And I think if Valerie was trying to demonstrate that to me, she did it with giving me those statistics. However, there are a handful of cases, and these tend to be the cases that if you're in this area, you've heard about. We'll talk about them just briefly. P.F. Chang's versus Federal is a fairly well-known case relying on a policy exclusion. District of Arizona held that a policy issued to P.F. Chang's did not cover fees and assessments that P.F. Chang's had contractually agreed to reimburse to its credit or its debit credit card processor that resulted from a data breach. And so what were the facts here? In order to facilitate a high volume of credit card transactions, P.F. Chang's had entered into a master service agreement, the MSA, we'll refer to it as, with Bank America Merchant Services, we'll call that BAMS, to process debit and credit card transactions. As part of the MSA, P.F. Chang's agreed to reimburse BAMS for any fees or assessments that BAMS incurred from MasterCard. In June 2014, hackers obtained and posted on the internet approximately 60,000 credit card numbers belonging to P.F. Chang's customers. In the wake of this breach, P.F. Chang submitted claims to Federal, its insurer, under its cyber policy. Federal paid P.F. Chang's more than $1.7 million for losses associated with the cyber breach. However, they disclaimed coverage for approximately $2 million, that's an additional $2 million, in fees and assessments which were imposed by MasterCard that P.F. Chang's was required to reimburse BAMS, to BAMS under the MSA. What happened? I can hardly wait. P.F. Chang's, so Federal says no way. P.F. Chang sues Federal for reimbursement. The court holds that, well, most of the fees and assessments are in fact covered losses under the insuring agreement. However, the court said the losses are subject to a specific policy exclusion. The court, in its analysis, turned to CGL cases analyzing CGL policies. And it said, well, listen, because these cyber policies are very new, we're going to turn to the CGL policy cases because the fundamental principles are the same. So even though we heard that the cyber insurance was supposed to get us away from all this uncertainty that had arisen under the CGL policies, guess what? The CGL cases are back. And P.F. Chang, and the P.F. Chang court said, we're going to look at the CGL cases. And so the court in P.F. Chang's looked at cases interpreting liability exclusions to apply to the assumption of another's liability, such as an agreement to indemnify or hold another harmless. And P.F. Chang said, well, wait a second. We'd be liable for some of these charges even if there wasn't this agreement under the MSA to indemnify. so we should have coverage. And the court rejected that. It said P.F. Chang's had not demonstrated that they'd be liable for MasterCard's assessments absent the MSA. And the court did reject an argument similar to the one that we saw was persuasive in the principal case, and they rejected an argument under Arizona's reasonable expectations case law, which I won't go through that whole analysis, but basically the policyholder said, well, look, we had a reasonable expectation in coverage here. After all, we bought a cyber liability policy. We expected cyber liability coverage. And the court basically said, wait a second, that's, you bought a policy with an exclusion, and you're a sophisticated party, you didn't have a reasonable expectation. So they rejected that argument out of hand, very different than what happened in the principal case. Another case, the Travelers versus Federal Recovery Services case, kind of a narrow case. Interesting, though, it does demonstrate that these cyber policies are not a panacea. There you had the District of Utah holding that Travelers did not have an obligation to defend under a cyber liability policy, which covered the language there. It covered any error, omission, or negligent act. And what was the underlying complaint against FRS? The underlying complaint alleged that FRS willfully and knowingly withheld data from its customer until payment was made. What were the facts? FRS was an electronic data processing company. They had a contract with this third party, Global, which I think was a fitness company, and they were going to handle the Global's membership dues and that kind of thing. Global subsequently transferred its business to a competitor, and they requested, please return our customer credit cards and banking information. FRS says, well, no, we're not going to give you that information unless you make unless we get more of a payment from you. So they said, the allegation anyway was that there was a willful, intentional withholding of Global's information. So Global sues FRS. Cause of actions asserted conversion, tortious interference, breach of contract, all this stuff. FRS has a cyber policy with Travelers. They tender their defense to Travelers. Travelers says, well, wait a second, this doesn't look like what's covered under our policy. They decline coverage, and they file a declaratory judgment action. And Travelers says, well, we don't have any duty to defend because Global hasn't alleged any error, omission, or negligent act, which would be covered by the policy. And the court agreed, stating, Global does not allege that FRS withheld data because of an error, omission, or negligence. Instead of alleging errors, omissions, or negligence, Global alleges knowledge, willfulness, and malice. So if you have a policy that covers negligence and you decide to do something willfully and intentionally, don't expect your insurer to pick up your defense. And a last case raised but didn't resolve kind of an interesting issue that may pop up again, which went to the policyholder's conduct in applying for the policy. And that was this Columbia Casualty versus Cottage Health case. there, the cottage hired a third-party vendor to secure cottage's records electronically. What did the vendor do? The vendor mistakenly set the file transfer protocol settings to allow public access. As a result, confidential medical records for approximately 32,000, 33,000 patients at hospitals affiliated with Cottage were compromised. Guess what happens? There's a class action. The insurer defended Cottage under a cyber insurance policy and funded a class settlement for approximately $4 million. However, the insurer subsequently sought reimbursement from Cottage, and they alleged that Cottage had misrepresented material facts in its coverage application, including that it would implement certain identified data security and risk practices. And secondly, Cottage's conduct fell within a policy exclusion requiring the Cottage continuously implement the procedures and risk controls which were identified in the policy. Kind of an interesting issue. However, before the court could resolve the issue and resolve the merits, Cottage was able to successfully move to dismiss the case because the insurer had failed to participate in a mandatory ADR, a mandatory alternative dispute resolution process, which was mandated by the cyber insurance policy. So that's another thing to watch out for. Yes?
Is that typical that a carrier would miss something like that?
I don't, not if they're represented by Saul Hewitt, but,
Okay.
but I guess my question for you is, are those ADR provisions typical in these
Yes,
products?
They are. And I would say that the exclusion that you mentioned that was in the CNA, which is the brand name of Columbia Casualty
Yep.
Company, that's no longer in their policy, and it's not standard in the marketplace either.
Okay.
It would be non-competitive, but.
And I think what we're going to hear is that there's a few of these things which, again, the marketplace may have changed as a result of the case law. A few concluding comments. ISO has said, look, it really would be good if we had standardization of terminology in cyber policies, would help avoid the potential for coverage disputes. It might help avoid litigation. And it's true. In the long run, standardization could lower the chances for disputes. And those disputes, they do raise claims management costs for insurers. They do undermine the certainty that policyholders want as to their coverage. And frankly, if you had some of that standardization, it might assist the market. But there's a big caveat, which is, as I said at the beginning, cyber attacks are going to continue to evolve, and new risks will continue to emerge. And as a result, the coverage afforded by cyber risk policies also will likely continue to evolve to reflect market demands, loss and claims experience, and, as we've been talking about, judicial interpretation of the policies. So any attempted standardization, at least at this point, may be difficult to achieve. So I am willing to entertain questions or turn it over to somebody who actually has the answer.
Pressure's on.
You don't have your little screen with questions from the audience?
I don't see any at the moment, so.
Good. Thank you.
Thank you, Robert. It's my pleasure to introduce Emily, who you've already had a chance to listen to a little bit. Emily is with our good client, Willis Towers Watson, and has been nice enough to come all the way from Boston to come down to speak to everyone today. And if you look in the back of her materials, her bio is there, but she is a vice president with Willis Towers Watson, works with the Finex team, and she provides risk management solutions in the privacy, network security, professional liability, media and technology disciplines. And without further ado, I'm going to introduce Emily, who's going to tell us all about the state of the cyber insurance market. So thank you, Emily.
Yeah, I don't have a clock, so if I'm running over,
I'll jump up and down.
Okay, good. Okay. Good morning, everyone. Thank you very much. So I have a presentation prepared. I don't know how much you've had a chance to look at it, but by all means, if there's any questions or directions that you want me to take this in, I'm here as a resource for you and could go on and on about cyber since it's what I do. So just a little bit more about my background. I've been on the broker side with Willis about 3 years, and previously I was with Legacy Ace underwriting similar types of exposure, so large network security, cyber, and professional liability policies. The first two slides are actually the core coverages that are in cyber insurance. So we've heard a lot about cyber insurance referenced so far this morning, but I think just giving a little more context to what that is may be helpful. It's important to keep in mind that these policies are modular, and so that means that you can pick and choose certain insuring agreements that you may feel best fits within the exposure that you're trying to transfer to the insurance company. So when you hear cyber, I would say most of the coverages that I'm going to discuss are included, but not necessarily all of them. And there may be a variety of reasons for that, but when we think about that Cambridge study as to, only 68% of policies cover this, or, event management or media or things like that, there could be many reasons why, including that there was a business decision not to purchase them as opposed to it not necessarily being unavailable. And it's called cyber, which makes it the inkling that it's just on the computer, but that's really not the full extent of what the coverage is. So the two key coverages are the privacy and network security liability. So think of this, the privacy, as just the liability that a company has arising out of personally identifiable information or corporate confidential information under your care, custody, and control. And this would be data in any format. So again, it could be electronic data, and it's obviously a lot easier to steal 80 million electronic records than 80 million paper records. But that's not to mean that there's no exposure for paper records. There's also could be spoken, as data evolves and authentication requirements change, fingerprints, eye scans, things like that. Just think about all the types of data and all the different ways that it can exist. That's what these policies are trying to cover. The other important thing to keep in mind that I mentioned was corporate confidential information. So the type of notification requirements for corporate confidential information are not the same as personally identifiable information, but that's not to say that there's no liability attached to it. So you may have your customer's information that's very valuable to you, that in the event that there's its access or breached, that you need some resources available to you, and that's where the coverage can kick in. The other key component of the coverage is your network security liability. So think of this as the coverage that you have, coverage that will address the liability that you have arising out of the management of a computer network. So nothing to do with private information, but simply to do with your computer network. So if we think of the Dyn attack, where it was essentially a denial of service attack, right? So there could be an interruption to your business. There could be some exposure there. It has nothing to do with private information. It just has to deal with your computer network. So again, those are the two core coverages when we think of cyber. Additional coverages that would be included and are also very important would be your media liability. And this, candidly is probably not going to be driving the coverage, the purchase of the coverage, but it's there, and that would be, liability that you have, based on any media that you're creating or distributing, or that someone else is creating on your behalf. And that would include social media content. Extortion costs and regulatory fines. So this is actually on both pages. So these are first-party coverages. So the extortion costs. So cyber extortion would be extortion reimbursement for extortion money that a company pays to end an extortion threat. So obviously this is going to be a ransomware attack. So someone's encrypted your data, they've demanded 300 Bitcoin, you pay, you come to the insurance company to seek reimbursement. So this is obviously we get a lot of questions from our clients about extortion coverage. I would say one thing that's really of note based on recent news and events, is particularly what happened in Europe last week, was frankly the very small amount that hackers are asking, or these extortion actors are asking for. So they're almost like nuisance claims. So, okay, well, it's like, I mean, not that $1,000, $10,000, $20,000 isn't a lot of money, but it is. But if you have a $250,000 retention on your cyber policy, perhaps you don't have a K&R policy, where there may be coverage for this. Sometimes it's just easier to pay than to almost like fight back or try to recover your systems. And so that's somewhat of a controversial subject, whether or not to pay or not to pay. I sort of have, my own opinions. I think the FBI offers their insight is to not to pay, but at the end of the day, we've seen clients and we've seen just in the press that organizations will pay to get their data released. And I think the WannaCry estimates were up to $50,000 of ransomware, which had been paid, which is, I think, extraordinary if you think of the scope of that breach versus the actual dollar amount. That a lot of these breaches have nothing to do with private information. They just want to disrupt your business, which is, not the greatest news. I don't mean to be pessimistic, but again, just thinking about the coverages. So the next item, regulatory fines and penalties. So I think this one is fairly straightforward. Where we see most activity for regulatory fines would be for HIPAA. We've seen FINRA take some greater action regarding privacy for broker-dealers, but not to the extent that HIPAA has. And if you have any exposure to EU, or you have a footprint in the EU, the General Data Protection Rule, or GDPR, which is going to go into effect next year, there is some pretty significant fines and penalties associated with non-compliance of that. And so until an actual fine has been paid and potentially tried to put under this policy, I can't say for certain whether or not the regulators will allow that payment to be transferred to insurance, but it's a privacy regulation, and this is for privacy fines and penalties. The last item on the slide is in regards to event management, and so this will have many different names: breach response costs, event management. But at the end of the day, what this is these are funds available to a policyholder to help address the initial costs in determining the cause and scope of a data breach. And so I sort of think of these as always in two buckets, right? So they're going to cover they're going to address what the company has to learn about the breach. So they're going to cover your forensics costs. Do you need to hire somebody from the outside to come in and determine what was on that last laptop? What was, there's malware downloaded on your computer. What type of information could they have accessed? Do you need to hire attorneys to determine what your notification requirements are? Do you need to engage a public relations firm, crisis management? Again, addressing the company. The second part of those costs would be for the affected individual. So think of notification and credit monitoring are going to be the two most commonly heard of types of expenses that would be covered, but there also may be identity theft, restoration service, fraud assistance. This would be if someone's data was stolen and then someone tries to take out a mortgage or a loan, and there needs to be some additional coverages or services offered. So it's a lot. I just want to pause. I know there's some people on live stream, but are there any questions on that? Because this is really like some of the core coverages before I go on to the next slide. No? Cool. Okay. So some of the additional costs, again, and I put in extortion and regulatory on both slides, but The other two key pieces of coverage, which I think are really important, are going to be your business interruption costs. And so this is one where we've seen some companies, whether or not they want to purchase, again, really determines on the nature of your business. But what this coverage is going to provide is income loss and extra expense associated with a system outage based on a security event. So think of a security event as you're hacking. Something that you do to protect your network security fails, and then you have an outage. So what's important to remember about this coverage is that there's two types of retentions, or two things have to happen for coverage to kick in. The first thing is that there's a time deductible. So that means that your coverage or your network has to be out for a certain period of time. And it's out for an hour and then it comes back on, and then it's out again for 2 hours and then it's back on. There has to be a measurable degradation of failure that has to be consistent throughout the time period. And we usually see those between 8 to 12 hours, and that's a long time for a lot of businesses. Additionally, you also have to incur a dollar amount of income loss and extra expense within that time deductible. So let's say you're out for 10 hours and you have a $500,000 deductible, but in that time period you only have $250,000 of income loss and extra expense. You still have to incur the additional dollar amount before coverage kicks in. So I think that's often sometimes questions that we get from clients and potential clients as far as where the coverage may or may not be, and I think understanding that is something that's important. One of the new coverages that we've seen in the marketplace come up as a result of organizations being concerned about the exposure from their IT vendors would be something called contingent business interruption, which I know we heard previously. So contingent business interruption can mean different things to different people. Sometimes it's called outsourced provider coverage, IT service provider coverage, but what it's essentially meant to do is say, if your IT vendor that you depend on to conduct your business has a security outage, which subsequently causes an outage for you on your network, then the coverage kicks in. And we have seen that this is very valuable to our clients, just given the nature of how IT systems work. Nobody is doing all of their own management of applications and similar type of services. Everyone is using outside experts for cost savings and frankly for performance. You can hire an expert to do it better. The data reconstruction. So this would be cost to recreate, recollect, or restore data that's lost or corrupted during an incident. So again, those are the core coverages, and so that I think are most commonly considered the cyber coverages when we're talking about that in the grand scheme of things. I think when we're talking about what's covered, we should also talk about what's not covered. So we've heard about other policies and what they've excluded. Some of the things that are not covered under a cyber policy, so there's no physical loss or damage. So we get this question a lot. If someone hacks into my HVAC system and turns on the sprinklers and my servers get flooded, is there coverage under my cyber policy? There is no coverage. Bodily injury to the extent of death, unfortunately, there are carve-backs for policies, under cyber policies, for emotional distress, mental anguish, similar types of results if there is a privacy breach. So this would likely be considered under, for a healthcare company. Let's say, for example, there's an incident and someone's data is released and the public or other parties subsequently learn that they've been treated for substance abuse, have a sexually transmitted disease, have been treated for depression, and those cause ancillary like mental anguish. That type of, there would be coverage for that, but not the death or dismemberment. So that's fairly consistent across the market, right? So those two things would not be covered. Theft of funds. So we've talked a lot about social engineering, hacking versus phishing. I think when you think of theft of funds, think of someone's tricking you into wiring money from one place to another. The value of that money is not intended, the cyber policy is not intending to cover that. So, but where can we cover that? Because that's a huge issue and concern for companies, right? Is that under your crime policy? Maybe, maybe not. Is that under your cyber? Maybe not. So what we've seen is slowly, some markets are willing to offer sublimits on their cyber policies for fraudulent instruction coverage or impersonation fraud. So someone tricks you into wiring money, or someone tricks your bank. You know, there's coverage there. They're small, you know, 250,000, 100,000, and so again, that money is money. So I'm not saying that it's not nothing, but you know, I think the market again is slowly moving in that direction. So you also may see sublimits on crime policies as well. There are solutions in the marketplace for some financial institutions that purchase a significant amount of cyber insurance and bond, where they will offer social engineering coverage. It's through London. And they can provide coverage in the event that there's gaps between the two. But again, that would be for larger financial institutions that have significant insurance towers for both crime and cyber, where there could be coverage for both. The last question that we get a lot regarding if it's covered or not would be liquidated damages. So depending on if you're working on a contract with a third party, we've received questions, and I've received this a lot on the underwriting side. We have liquidated damages provisions in our contract. Is that something that we can transfer to insurance? And no. So, any questions on what's not covered? No? Okay, well, I'll keep going, and if someone online has questions, I can always come back. So I want to talk a little bit about the cyber insurance marketplace. So, and this was a little bit different, I think, than some of my next slide has some different information than you mentioned, but we're close. Just given an idea of how much organizations, mostly in the US, are purchasing cyber. So the expectation is going to grow to $2.5 billion. If you look at the bottom of the chart, which you can't really see, the top 10 carriers for standalone and packaged cyber coverage is $894 million right now. So, I think, that's the number of premiums. $998 million would be the direct written premium. So it's a little under $1 billion. It's going to grow to $2.5 billion in the next 3 to 4 years. So you can see again, and that's not surprising. We've heard a lot of about cyber insurance. So I think this is generally supporting the trend that we hear of in the media. So where can companies buy cyber insurance? So typically it's out of the US. US companies are the largest purchasers of this coverage. I think with the rollout and implementation of GDPR, we're anticipating that more European companies will purchase, or European companies will purchase for that exposure. Some will already have coverage in place here in the US. Lloyd's market has cyber insurance, and then Bermuda as well. So it's nice that there's a large market or in capacity essentially, which we'll get into a little bit later, that's available to companies from which to build a substantial risk transfer program if that's what they need. Coverage is typically written on a standalone basis, meaning it's just your cyber insurance coverage. We do see frequently companies will purchase along with their professional liability, mostly because of their business essentially involves taking personally identifiable information of their clients, and so their clients are essentially demanding it. You have personal information of our customers. If you fail in your professional service to us, there's going to be a privacy breach, and you need to have both coverages. Offered on a package basis as well. You can see on number 6 is Travelers Company on the largest writers of cyber insurance, and I would say anecdotally the majority of that would be on a package basis, where AIG, Chubb, XL, and Axis, and Beasley are likely more diversified between the standalone and the package. So, you know, really just depends on the exposure, how you feel you want those limits shared with other insurance that you're purchasing, budget, things like that. But typically the clients that I work with have it on a standalone basis or with their E&O coverage. We talked a little bit about about how cyber insurance may be or maybe not under, you know, CGL, crime, E&O. One of the things that we work with on our clients is determine where there may be pockets of coverage to make sure that those policies don't bump into each other, meaning you don't have two other insurance clauses that are saying, well, if there's any overlap, the other guy's doing it. And so you have two carriers pointing fingers at each other when you just want to get your claim paid. So the three largest areas of where there could be overlap, managed care E&O sometimes will offer like HIPAA or other privacy-related funds, typically on a sub-limited basis. K&R, which would be your kidnap and ransom policies, which I know you're not technically supposed to tell people that you have, but there could be some coverage for extortion costs, and depending on your retention, it may be best to have your cyber policy sit excess, which you can do, and of course the cyber carriers are going to want to do that. They'll be further away from the risk, right, so that you can get your K&R policy to respond first if there's an extortion threat. So could be an option, could not be an option. I put property in here because FM Global last year released a cyber enhancement to their policy, and so FM Global writes a significant amount of property. That's what they do, and so they have provided limited business interruption coverage, and so there is some potential overlap with the business interruption coverage that we mentioned before. There is also the ability for that physical loss or damage to your systems. I will say that based on our work with FM, based on the clients, because most of our clients will go direct, they are putting it on a sub-limited basis for no additional premium, which is a nice enhancement. They also will offer an endorsement where if there is any overlap, the company has a certain period of time to determine which policy they want to respond first, which I think again is a great option for the clients, because if there is overlap, there may be one, based on the facts, there may be one policy that would respond better. And then again, this chart is just some of the carriers, the largest carriers based on if the Fitch ratings. And I would say, anecdotally, I would agree with that. I mean, we see AIG, Chubb, Beasley, XL, and Axis as our largest carrier partners. And they've been writing cyber insurance the longest. Any questions on that? No? Cool. Okay, keep going. The next two slides just talk a little bit about the general spending that we're seeing for cyber. And I would say that when we're talking about cyber here, we're thinking of a larger universe than the insurance. And so this, it's probably pretty small up here, but on the papers you can see that global spending on cyber is expected to grow 9%. The largest chunk you can see is IT security, which is definitely supported by the next slide as well, right? So this shows the particular growth in the categories. IT security is going to be the largest chunk of money, which I think makes sense. One thing that we've seen, on the insurance side, where the claims are coming from, a lot of it deals with employee error, right? So someone clicks on a link, they're busy, someone doesn't log out of their computer, someone leaves the computer on an airplane. So despite all that money that you have on your IT, and you can have a significant spend, you can have the best type of security possible, but at the end of the day, it's humans installing it, humans maintaining it, humans updating it, and we all make mistakes. And so while I think that it's nice to see that there's some increase in that learning and development, it's still small. So I think, hopefully that will what we end up seeing in a few years, it'll show a little bit more of a bump in that respect. But, I think all of these really, commingle together, right? Strategy and assessments, how well do you know where your data is, and responding to a potential breach, so incident response. It's not a matter of if, but when. So do you have the plans in place? Are you practicing? Are you making sure that you know the right people? You have the vendors in place? And those can cost money, using an external vendor to help you run through that and give you the best possible practices you can, so that when it does happen, you know who to call. So these two slides are basically saying the same thing, but the next item, going back to the insurance portion, this is from the Advisen survey, and it's actually included in in your presentation materials. But this just shows what the uptake rate is for cyber insurance, right? So it's one line's going down, and that's the number of respondents answering no. One's going up. So you can see that the delta is getting bigger as the years go on. There's still 23% of respondents that are not purchasing, or as of the end of, for the 2016 report. And there could be a variety of reasons why they're not purchasing, but it's certainly a pretty big change if you think just over 5 years and how insurance trends typically go. So the uptake rate for industry, so we've seen healthcare, financial services, and retail really be the early adopters of this. Financial services are heavily regulated industries. Healthcare, obviously, they have HIPAA, and so there's more of a culture of privacy within those organizations. I would say healthcare companies, struggle with just dedicating the appropriate financial resources. Obviously, it's expensive to continuously update IT and insurance spend, and so it's just where those dollars go. And then the other document that's in there is the RIMS cyber survey, which shows that 80% of respondents are purchasing cyber. So a good amount, but certainly not everyone. So there's still some companies that have made the decision not to purchase. So the next slide. So there's a lot on here, and this is, but I do think that it's a good slide, especially as a takeaway. I do want to touch on a few things, and this is something that we talk about with all of our clients, right? So what's going on in the marketplace? What are we looking at as brokers? What are the underwriters concerned about? What's the good news? What's the bad news? So we look at it in a variety of different criteria. The first is capacity, and that's plentiful, and that's really good news if you're a buyer. So I would say it's premature to say that it's a soft market, meaning prices are going down. I would say that the market is really competitive. So where you were looking at a retailer back at the end of 2014, the prices were going up 50, 75, 100%, with the retentions going up 50, 75, 100% as well. Now we're seeing markets be a little bit more competitive and aggressive, and either buying, either wanting to keep their business or get new business as well. And so I think, again, that's good news for either companies that purchase now or have made the decision to not purchase, to consider going into the market now, just given that the market has favorable conditions. So let's say you wanted to purchase as much capacity as you possibly could. We're aware of a $600 million placement. And this would be using capacity out of the US, the UK, and Bermuda. And this would be for a large organization out of the US with a significant retention. So I don't know if anyone wants $600 million, but that's the biggest one. I would say the other items of note is that we've heard a lot. Well, there's no standardization in the forms. I would agree. We talked again in general at the beginning, like what coverages are and are not provided. We see carriers constantly updating their forms, trying to stay competitive, provide enhancements, and so that can be challenging when you're making the decision to purchase, given you're trying to get educated on the nuances, and then 2 years later your carrier changes the form and you get this marked up red line version and, what does all of it mean? So, that can make it a little more frustrating, but from our perspective, again, it's enhanced coverage, improving terms, clarity, and then again, just more options for our clients if they decide they want to purchase. Coverage is expanding, right? So again, I mentioned that there's a competitive marketplace. We talked a little bit before about FM Global and their offering on cyber, and as well as the social engineering coverages for those loss of funds, and that carriers are slowly dipping their toes in providing that. And so I think that again, it's responding to what organizations are concerned about. And so, again, it's promising for us. We'd like to see greater clarity on some, again, including those theft of funds, but the market sometimes can move slowly. Claims and losses are rising. So again, we spent some time before talking about case law where there may or may not have been coverage. I can tell you that these carriers are paying cyber claims. There is a significant amount of claims being paid under these policies. So whether it's lost laptops, hacking, employee negligence, human error, these types of claims are being covered and addressed by the carriers, which is good. We've seen our data shows that 66% of claims emanate from human behavior. Again, going back to that little sliver that's dedicated to learning and development versus the IT. How much can technology truly protect us from human error? That's a bigger picture question. Underwriting concern. So this is one thing that I think is of interest regarding the underwriting process, and we'll talk about that a little bit more, but underwriters are constantly concerned about, where are claims coming from? So if you followed the WannaCry attack and what happened, there was Windows XP is no longer supported by Microsoft, and so we would often get questions from underwriters even before this on end of life or end of use software. So is there software that you have on your network that's no longer supported by the manufacturer? And how do you protect against that information? And that's a really important question for carriers, because this vulnerability was known prior to this breach. So there was a leaking of NSA hacking tools. The NSA notified Microsoft to release a patch. Microsoft released a patch, but yet a significant amount of organizations did not patch their systems and were essentially were influenced by this hacking event. The other thing I think to keep in mind, and again, I don't want to be too much of a downer, is that the way these tools are available on the web, you don't have to necessarily be a computer science genius to launch an extortion attempt or denial of service or pick your poison, right? So if you go on YouTube and you look on hacking, you get tutorials essentially, and you can learn how to do these things. And so it doesn't, the threshold for releasing these attacks is lower than what it was. And then you have NSA hacking tools released to anybody who is willing to look at them, right? Because the shadow brokers put them online for free. It's a pretty big animal to contain. And again, not to make anyone nervous or feel like they have to go off the grid. I just think it's a realistic picture of the type of threats that organizations are facing, and the fact that underwriters are concerned about how things are protected, especially when vulnerabilities are known. Premiums and retention normalizing. So again, the market's a little more competitive. We're seeing some pockets of softening, but again, I would say it's premature to say that it's soft. And then, if you haven't purchased before, you're able to maybe get a lower retention than you were 2 years ago, or if you purchased 2 years ago and you want a lower retention, we can maybe achieve that for you. So again, the conditions are favorable. Markets are unaligned. Again, I think this is just going back to sort of the theme that there's no standard form in the marketplace, and so there are certain philosophies that certain carriers have regarding this coverage, and it's really important to understand how that would align to how you want to purchase your insurance. So again, there's a lot on this page, so certainly after if there's any other questions I can answer. Some of the considerations on purchasing cyber insurance, so when we hear from our clients, why are they deciding to buy now? One of the key drivers would be contracts. So they're required in a contract to purchase cyber insurance. Sometimes they can get it removed, sometimes they can't. At some point, the business that they look to engage is going to say, you need to have risk transfer for this. We're not letting you keep it by yourself. Regardless of the financial strength of the company, they want to know that someone else is engaged. And so even if you have minimal contact with their personally identifiable information, if you have minimal contact to their computer network, we have organizations that go in and measure people for uniforms, and because they're on the premises collecting information about their employees, they need to have cyber insurance. So the media, so I mean that's a pretty big term, picks up a lot of things, but we've often gotten phone calls that someone heard about WannaCry, someone heard the New York Department of Financial Services is releasing a regulation. Now that regulation does not require the purchase of cyber insurance, but previous iterations did. Following on WannaCry, there's often people at insurance carriers or brokers are interviewed. Senior executives, again, that's very broad and somewhat captured into what I was just talking about from the media, but when thinking about, perhaps there's a new board member, a new CISO, a new CIO, they come in and they're looking to just get a better lay of the land, and part of their initiatives is to make sure that cyber insurance is purchased, checking the box type of thing. And then regulatory concerns. So I mentioned the New York Department of Financial Services, GDPR, HIPAA, some FINRA. Again, HIPAA is going to be the largest, most active area where we see fines and penalties coming from. It's been around a long time, but still, I think as state attorneys general want to be more active, or other organizations are looking to get more funds, this could be a way of getting funds. So we've seen that. Those are sort of the key areas. How do you decide with whom to go with, right? What's the risk management approach with your organization? So a lot of times when we work with clients, we want to understand if they're more comfortable taking on a significant retention, if they want to have more control over the claim, if they have breach response vendors engaged already. So do you have someone that you've already you have a contract in place for notification? So it doesn't really matter to you that Beasley can help you with that, because you have a carrier, you have an organization rather that you're comfortable with. You know them, they know you. You don't want anybody else involved. Or on the flip side, perhaps you do want a significant amount of carrier involvement. You do want them to be actively engaged in the claims adjusting. And of course, like Willis is involved too, and we want to maintain control and ownership of the claim process. But where the carrier has experience and can help you, that may vary based on your organization. And so that's part of when we're working with clients, how we figure out which carrier may be a good fit. Cost and relationship with carriers. So obviously, insurance is the most expensive thing you buy until you need it, and then it's the best thing you purchased, right? So, but I think a lot of people hear about certain claims that aren't covered. They get a lot of attention. The waiting periods can be a long time, and some people say, well, why am I going to bother spending all this money and I'm not getting covered for what I want to be covered for? So I think that's all part of, when we're working with clients and what makes the decision as to who to go with or to go with coverage at all. And then the last, just the relationship with the carriers. Have you had bad experiences before? Have you had good experiences before? I think there's certainly pros and cons to developing ongoing relationship with carriers. Obviously, we don't want all of your eggs in one basket, but where can we take advantage of, maybe there's a significant insurance spend on your property or your general liability, can we leverage that to get you improved terms and conditions and cost for your cyber? So again, all parts of like why people would, or how our clients depend on who to bind with. The underwriting process, so very similar, I think, to other insurance lines. It's a pretty long application, unfortunately. I'd like to say it's 3 pages. Some of them, the shortest I think is 6. The good news is that one carrier will accept another carrier's insurance application. For our larger clients where they may have, they're either larger organizations or they're more higher risk, so for healthcare, there may be additional information that's requested. Sometimes we'll do phone calls with the markets, and we just try to prep our clients on what to expect and how to answer. And really the underwriters are not, they're not IT experts, right? So some will supplement their underwriting process with IT, security professionals, but really it's just, they want to hear that the policyholder understands where their data is, what their exposure is, and how they address it. And so I think that overall philosophy can really help in the underwriting process. And then, ongoing, depending on claims or, your business on, initial or further renewals may not be as labor intensive. But it's, again, I won't lie, like it's a lot of work for our clients. And so, we try to make it as easy as possible, but unfortunately there's only so much we can do. And a lot of it's just, houses with different people. Are there any questions on that? Yes.
Emily.
Yeah.
A couple questions on the use of outside consultants by cyber insurers.
Okay.
As I understand it, they use them at both ends.
Yeah.
You have a cyber consultant who is at the underwriting end who may come in and look at your systems. How does that work? Who bears the cost for that? And then at the back end, you've mentioned that you've worked with your clients to have them decide whether or not they would prefer to have their own law firms, their own consulting firms do that. How does that affect price, and how do the insurers deal with a client who comes in and says, okay, I don't need your consultant or your law firms, I have my own, and what are the considerations that people may have in that process?
So to answer your first question, we've seen some carriers hire security professionals, and they will be engaged with underwriting and just determining where there could be potential gaps in coverage. But we have not seen carriers requesting to do audits or on-site visits. There's some policies that offer more capacity, so they'll offer 30 to 100 million from one carrier. And with those, the underwriting process is a little bit more intrusive. But they're offering, their response is, well, we're offering more limit, so we need to get more information. But for the most part, they're just supplementing. They're not coming on site. Does that answer your question? The first part. Okay. The second part, it depends on the carrier. So we have some carriers that they will offer, if you can either choose to use their panel, their breach response panel, or you can use your own vendors. So they'll say, okay, if you use our vendors, you can get this much of limit. If you use your own vendors, you get this much limit. Some carriers will say, if you use our vendors, you can get this much limit. You can use your own vendors, but we're only going to pay your vendors what we pay our vendors, right? So, and through the relationship with the insurance carrier, they may get better rates than you may get standalone. The distinction, the only difference or the only outlier would be your straight defense counsel. They have panel counsel. If you have a vendor, if you have a law firm that you want to use, they'll put rate caps on. So, and those are unfortunately particularly stubborn. So, I'm sure that's not newsworthy to anyone here. So, so what role can we play in the process? So as your broker, so what we want to do is give you an idea of where the exposure is coming from. Where are we seeing claims being paid? Where are we seeing incidents, right? Because we certainly see incidents that are not necessarily reportable under policies, that may not erode the retention, so maybe aren't aren't getting paid, but again, there's still incidents and relevant to our carriers. Threats and exposures of interest to underwriters. So now, like with the WannaCry attack, all of our carriers are asking about unsupported or end-of-life software. Previously, when it was at the end of 2014, it was what type of end-to-end encryption do you have for if you're a retailer, because that's where a lot of the Target and Home Depot breaches were coming from, right? Unencrypted data. Also, what type of controls do you have regarding your vendors, right? So Target was an HVAC vendor. You know, do you have categorization of your vendors, high risk, low risk, and how do you segment them and their access to your network? So where they see large, high profile claims coming from, that's where they're going to ask a lot of information. And then where they're seeing activity in their book. Interaction with other insurance purchases, again, we talked a little bit about where there may be overlap with other policies. You know, can we help you determine, well, your K&R coverage has a 0 retention, let's put that on top. Perhaps you don't have K&R, you don't want to say that you have K&R, that's fine. And then recommendations on other insurance-related coverages and claims advocacy. So, you know, we have a pretty large claims group. They come from, you know, the private sector, they come from carriers, other insurance brokers, and they can help guide the clients through the process, which, you know, I think makes a huge difference. Obviously, you have your own legal counsel, you know, your outside counsel, but again, you know, another set of eyes that can help you through the process. That's the end. I don't know, are there any questions? Did I talk too fast? No? Okay, all right.
Well, actually, before you go,
Yeah.
a couple of things.
Okay.
One, if you have like a top 5 list when you're
Yeah.
talking to your clients
Yeah.
saying, what are the things you really need to think about
Yeah.
when you're going to go out and buy cyber insurance?
Yeah.
What would you say are those top 5 things?
You mean like why shouldn't they? Why should they buy?
Or they may have already made the decision to buy.
Yeah.
But they now have to think about how much to buy,
Yeah.
what to buy,
Yeah.
why are they buying.
Well,
those
I think
things.
I would say if you're thinking how much to buy, so there's a few different tools that you can use. There's benchmarking, which we have some data for, right? So we have our own internal client suite that we can provide, you know, names redacted, but, you know, industry, limit, retention. We also have a very great analytical tool like Willis has, and I can't speak to other brokers, but what this tool allows us to do is it essentially runs a Monte Carlo simulation against a data set of over 10,000 breaches. And so what it does is it uses your certain criteria that you give us, which is essentially your record count, so the number of unique records that you have that could be exposed at any one time. It's under your care, custody, and control, and your revenues. And what it'll do is it'll tell you, okay, well, in any given year, you can expect to see, you know, an average breach size of X, right? And so then you can see what that cost would be. And then, you know, it does a it's a matrix essentially, and so it says, okay, well, if you want to insure 95% of all the possible breaches that could occur in a year, you know, that it's going to cost this much. You want to insure 90%, it's going to be this much. And so it can give you an idea of what the breaches may look like. There's also the cost calculator component, right? So you have 100,000 records breached, 1 million, 100 million. Have that many, you know, okay, well, you're going to have this many in breach response costs, this many in civil liability, this much in, you know, regulatory fines and penalties, and you see how they break down. And that has been a really helpful tool for our clients in determining how much to buy. I don't remember what the other components were, I'm sorry.
Something like, you know, what should they be buying?
Yeah.
Because as we talked before,
Yeah.
there are various different components to.
Right. So the clients that we work with, most of our clients are going to purchase the network security, the privacy, the breach response costs, the event management, the regulatory, the cyber extortion. Where we see some organizations really varying would be that business interruption cost. So the disruption to your business, and that is really driven by their internal business continuity studies. So they may have business continuity studies that say, we've done all this testing and there's no way we're going to be down for more than 4 hours. And we know that 4 hours waiting period is not available in the marketplace. We're going to make the decision not to purchase. And so there, and that's, is it possible to have an outage outside of what your business continuity plan says? Yes, I think so, but is it worth the additional money? Do you want to go up against your business continuity test? That's, sometimes can be a little more like political, and so that's where we see some companies making the difference.
Okay.
Yeah. Yeah.
Oh, no, go ahead.
Do you find that carriers are giving discounts for any type of proactive breach services?
You mean like you want to go ahead and hire an someone to do an incident response? Will they pay for it, or? Sorry, I guess I don't understand the question.
So are carriers providing discounts for companies that do proactive work for like vulnerability assessments, pen testing, incident response planning?
Yeah, so I would say that carriers' expectation is that you're doing all of those things, right? So that you're doing incident response planning, pen testing. Those are all parts of the application. And so I think their expectation is that's part of a reasonable secure information security plan. As far as how, they likely will evaluate. I can tell you when I was an underwriter, you evaluate, do you think that this company has fair, good, excellent security? And so I think all of those things would go into the rating of it, but how it would break down on like the individual activities, it's hard to tell.
We do have a question from one of our streaming viewers,
Okay.
and I think you've answered part of this. I'm
Okay.
not sure if you've answered the whole thing. But the question is, regarding determining a limit of insurance to purchase,
Yeah.
what steps do you take clients through to select an appropriate limit?
Yeah, so again, we often we use benchmarking, we use our Cyber Quantified tool. For those organizations that are required to by contract, we'll often use is there a certain level that you're required in your contract? Do you want to give yourself a little bit of a cushion? I would say most of the clients that I work with buy between 5 to 10 million in coverage, and we deal mostly with like 100 million in revenues and over. On the underwriting side, we saw much lower purchases for smaller organizations that maybe had less exposure. They just wanted to, they just wanted to kind of show that they had the coverage, and so it's only $1 million. You have $30 million in revenue, and $1 million is going to get you the coverage that you need because you have 10,000 records. Yeah, so.
We actually have another question.
Okay, good.
Which along the same lines, and what it says is, what type of advice would you give to companies on determining coverage limits for cyber insurance? Is there any guidance available to determine what amount of insurance is sufficient? It seems that many of the breaches that have been discussed, the coverage limits were insufficient.
Yes, so like with Target, right, and that wasn't, a lot of the limit depends on the cost, and then at some point, are you comfortable just taking that additional risk on yourself?
Mm-hmm.
And if you feel, let's say you feel that your biggest exposure is the property damage. You're a manufacturer, and or a construction company, and you think that the biggest exposure that you have is relating to property damage out of a cyber incident. Maybe you don't need 100 million. Maybe you need 10 million, and because that what you want to have transferred isn't available, or it's available but it's $400,000 in premium for every $1 million in coverage, or even more. So that's all part of the, working with your broker to determine what your exposure is, what can be transferred to insurance, and if the majority of it can be transferred to insurance, do you want it all transferred? Do you want to transfer as much as possible?
Right.
Target could have purchased 300 million of coverage. Would it have been worth it to them versus waiting to see if they got that? I don't know. I say more, but I'm a broker, so I think I'm predictable. So.
One other question.
Yeah.
The New York regulations
Yep.
and the new Model Act coming out for the NAIC all impose some obligations on insurance companies
Yep.
and really all financial institutions to look hard at their third-party vendors.
Mm-hmm.
And in some cases, to take liability for those third-party vendors for the things that they do. And we've heard from some other speakers in some of our prior workshops that one would have thought that for example, from an insurance company perspective, you would have bargaining leverage with your third-party vendors to say, okay, we're not going to be responsible for what you do. You're going to buy coverage, but they're saying that ability to do that bargaining leverage isn't always there.
Yeah.
So when that happens, when you don't have the ability to say to your third-party vendor, you buy enough insurance to make sure that I am covered. What is an option for?
Yeah, so there are options through cyber and the insurance policy. So if you have information that you then send to a third party for whatever reason, let's say it's your HR system and you're sending it to PeopleSoft, and then PeopleSoft has a breach, there is the ability for this policy to be triggered. And that because they're considered an information holder, and so really, again, this goes back to each carrier takes a different approach to information holder. But in general, what this category of companies is any organization that you provide private information to, or that has private information or personal information on your behalf. So think of Anthem, right? Anthem, we had some clients whose one of their health insurance providers was Anthem. So their employees were affected, and employees would be covered under these policies. Now, as a policyholder who uses Anthem as a healthcare provider, you didn't do anything wrong. There was no wrongful act. However, they have information that you're responsible for, that you've given it to them. So the policy could be triggered, and I know again it's a little complicated, but the idea is that, whomever takes the data essentially needs to be responsible for it, and that's probably the driver between taking on some of that liability. And I think these insurance policies have addressed it. Now, whether or not you want your insurance policy to respond in that instance is another story, right? Do you want to put your carrier on notice for a breach that was not your fault? Maybe, maybe not. Is it, and that's, again, where we can help you say, our recommendation was it's a good idea, too, because you put a flag in the ground to essentially say, hey, there's this circumstance, you've heard of it, we think that Anthem's going to address everything, which they did, but we just want to make sure that we're covered in the event there's any liability down the road from our employees for whatever reason. And then the insurance, if there is, and the insurance policy pays, and they have the ability to go and collect from Anthem. So.
Okay. Any other questions?
Okay.
All right. Thank you, Emily.
Yeah,
Appreciate
sure.
it.
Thanks.
Well, as I said at the beginning of this workshop, I have the enviable task of being able to phrase the question and then leave. And so now it's time for us to leave and to end the workshop. And so thank you all for coming. And for those who are live streaming, thank you all for attending. Again, a reminder, housekeeping reminder, if you haven't filled out the CLE forms or CPE forms, they're over there against the wall. And for those of you who are here, there'll be lunch served on the other side of the curtains. So thank you very much for coming, and we really appreciate it. It was nice to see everybody.